If you look at Eicher Motors, one of the best performing stocks, it first gave 30x and then again jumped 70x and made massive wealth for its investors. And by the way, for the people who missed that journey, there is another Eicher Motors being built right in front of our eyes. This company is changing how two-wheelers are made. It is a EV two-wheeler company and the stock has already started its rally. And if you don't want to miss it, then watch this video till the end because I'm going to explain why this stock can be good to hold in your 2030 portfolio. And I personally love how the company is performing. 63% sales growth, 37% profit growth, and its stock price after IPO listing has rallied from 300 rupees to 1130 rupees. But here's the painful part. Almost nobody who bought the stock actually made good money. I talked with many of my clients and investors. They all sold way too early. But think about this. If you would have bought the stock at 500 and it went up 25% in just a few months, what would you have done? Most people would have sold. And that is exactly what thousands of investors did. They made 25%. They felt smart and then they watched from the sidelines as the stock went up another 50, 100 and 200% without them. But why does it happen? Because we treat our broker app like a cricket scoreboard. Green means we are winning, red means we are losing. And the moment we see green, we want to lock in that win like it's going to disappear. But investing is not like cricket. You don't need to protect your score. You need to let the winners run. So I feel before we directly jump into the stock, let me first explain you why you should be holding it for long term rather than short term gains. And even if I tell you a good stock name and you invest in it today, the moment you make small gains, you will exit the stock. But not this stock. This stock has multi-bagger potential. So let me tell you a real life story. A few months ago, I was at dinner. Someone found out that it was me and they came to me and asked the most obvious question. Which stock should I buy? So I mentioned the name of a company, Acutas Chemicals, which we personally track very closely at RangaOne Finance. Most of you might know it by its old name, Amy Organics. And for disclaimer purposes, it is a part of our multi-bagger portfolio and this is not a buy or sell recommendation. And before I could even explain what this company does, this person pulled out his phone, looked at the chart and said, "Are you serious? This company has rallied 6 times since its IPO. It's way too expensive." He did not ask me what the company does. He did not ask me about their growth. His entire decision was based on one single thing. The stock chart looked way too high. Now this is what I call the already gone up trap. People assume that if a stock has already rallied a lot, it must come down. Now this incident was back in November 2025 and since then Acutas Chemicals has rallied more than 70%. See, a stock goes up because the business is growing and if the business continues to grow, then the stock continues to go up. It's that simple. Let me quickly tell you why this business is so fascinating. Acutas makes those invisible chemical building blocks that goes inside your medicine, heart medicine, cancer drug, depression treatments. They even supply to companies like Cipla, Dr. Reddy's, Sun Pharma and even global pharma giants. But here's the real magic. They have something called as a CDMO model. Let me explain it in simple words. Imagine a big pharma company wants to make a patented cancer drug. And they need a very special chemical ingredient for it. So they pick one company to make that ingredient. And once they pick you, your manufacturing process gets locked into the drug's government approval. And if they want to switch to someone else later, they would have to redo years of testing and compliance. So basically, once you're in for the life of that patent. Now that is 10 to 15 years of guaranteed business. And Acutas has exactly this kind of a contract with a Finnish company called Fermion, which makes the key ingredient for Bayer's cancer drug. Now that is a 10-year deal plus a patent protection running till 2033-35. Plus, they are also making chemicals for semiconductor manufacturing. And that is another moat. Now let us have a look at the numbers. Now the revenue has gone from 240 crores to over 1,300 crores in just 6 years. And the profits from 27 crores to over 350 crores. And they are not stopping at pharma. They are now expanding into semiconductor chemicals and battery materials. So the growth runway is massive. But that person at the dinner, he will never buy it because he's stuck looking at the past chart instead of looking at the future business. Let me show you what I mean. Let's go back to Royal Enfield. If instead of checking the share price every day, you would have simply tracked how many bikes they were selling each month, you would have seen this. 5 lakh bikes a year, then 6 lakh, then 8 lakh, then crossing 10 lakh bikes a year. Their market share was growing. Their exports were growing. Every single month the business was telling you, I am getting bigger. If you saw that, would you have sold at just 25% profits? Of course not. You would have held it with full confidence because the business was clearly winning. So those who sold early, they were just watching the stock price. And the people who made 30x, 70x returns, they were watching the business. Now you might be thinking,
Sanika, Eicher happened in the past. What about today? Is there something like this happening right now?
yes, it is happening right in front of us, and that also in Aether Energy, the EV scooter company. Now one of my friend bought this stock after its IPO, and within a few weeks the stock was down 15%. He panicked and sold the stock saying that EV stocks are risky. But look at what the business was doing while he was panicking about the price. In 2019, Aether sold just 2,000 scooters the entire year. Then 15,000, then 50,000, and then 2 lakh. And this year they are on track to cross 3 lakh units. And their market share in EV two-wheelers has gone from just 2 to 3% to nearly 19%. They have left Ola Electric behind and became India's third largest EV two-wheeler company. So my friend sold because the price dipped 15%, while the business was doubling every single year. Now comes the important part, and I'm not telling you to buy a good company and hold it forever blindly. That is equally dangerous. Let me show you what happens when you hold a company blindly. Natco Pharma. Now a few years ago, they got permission to sell a cheaper version of a very expensive cancer drug in America. It was a gold mine. Their profit jumped from 700 crores to 1,800 crores in one shot, and the stock flew to 1,600 rupees. But here's the thing, that permission was temporary. After a few years, other companies would also get the same permission and Natco's profits would come back down. So this was not a permanent business advantage. This was a one-time jackpot. And the people who understood this, they sold near the top. And the people who said, great company, I will hold it forever, they watched the stock crash from 1,600 all the way down to 700 rupees. Half of their money gone. So the lesson is clear. Holding is powerful, but blind holding is dangerous. You need to understand whether the company's growth is permanent or temporary. Now coming back to Aether, you must be thinking,
Sanika, Aether's story sounds great, but what do I actually do with the stock right now?
let me break it down for you. Rule number 1, never buy at the peak. If you take a look at Aether's chart, there is a clear pattern. Every time it makes a new high, it pulls back 10 to 20% every single time. And this is normal. Even the best stocks in the world take a breather after a big run. So this is now a buy on dip stock. You don't chase it when it's flying. You wait for that 10 to 20% dip and then you step in. Rule number 2, allocation. Never go overboard. I have seen people put 15-20% of their portfolio in a single stock just because they are excited. But that is a recipe for panic and disaster. And for a stock like Aether, which has already rallied aggressively, keep the allocation around 3% of your portfolio, not more. And always keep cash for down averaging, because if the stock dips further after you buy it, then you should have the ability to add more at lower prices. Now technically speaking, where is the buy zone? See, the current support sits near 954 rupees, and that is a strong level, and I'm personally looking at the 950 to 970 range to enter. And if you check the RSI, it is near 70, which means that the stock is in an heated zone right now. It needs to cool off. And when it does, that is your window. And one more level to keep in mind is 732 rupees. Will it come there? Probably not. 99% chance it won't. But if some unexpected event brings it there, now that is a rock solid support. that is where you go aggressive. So the bottom line is that there is fundamentally nothing wrong with Aether. The business is firing on all cylinders, but technically it needs a breather. And smart investors don't buy a stock when it is overheated. They wait for it to cool down. So wait for a dip, it will come. So let me give you the complete framework. When you're holding a stock and you're confused, should I sell or should I hold? Ask yourself one simple thing. Is the reason I bought the stock still alive? If you bought because the company was growing its sales every month, ask, are they still growing? If you bought because the company was gaining its market share, ask, are they still gaining? If you bought because they had a unique product, ask, is the product still in demand? If yes, then hold the stock. Ignore the noise, ignore the red days. The business is doing their job. If the answer is no, if the growth has slowed, if a competitor has taken over, if that one-time advantage is ending like Natco, sell. Don't be emotional about it. Sell and move on. That's it. That's the entire Techno-funda approach in one line. Buy the business, track the business, and sell only when the business changes, not when the stock price scares you. And this is exactly what we follow at RangaOne Finance. Our allocation discipline is what sets us apart. You can read the feedbacks over here. You can choose from our 3 portfolios. We have Multibagger portfolio for risky investors, Stability X Growth for safe investors, and now we have the US portfolio for those who want to diversify geographically. So if you want more details, just visit our website RangaOne.finance, scroll down, and here you will find our 3 model portfolios. You can choose them according to your investment style. And as always, this was Sanika from RangaOne Finance, a SEBI registered research analyst firm, and I will see you very soon in the next video. Till then, bye-bye.
Investment in the securities market is subject to market risks. Read all the related documents carefully before investing.